With Paul Hickin, Associate Director of Oil at S&P Global Platts. Paul, hi, thank you so much for coming on board. There's the event that has transpired over the weekend, the drone attack on Saudi Arabia's Aramco. Definitely, there's a sudden change in geopolitical risk that warrants not only an elimination of 5 to 10%, $5 to $10 per barrel discount on bearish sentiment, but also a potential premium. Which way do you think oil prices will be headed? Will this be a short-term impact, or are we likely to see it impact over the medium to longer term as well when it comes to the prices?
I think you're right. There's twofold factors here. First of all, the attacks at the weekend have shifted the bearish tone in the market. You've got to remember that up until last week, we were talking about the demand problem in the global demand as an issue. It was bearish for oil. It was keeping that cap on $60. Now that's changed. We're back now talking about geopolitical risk, and we've had geopolitical risk in the backdrop throughout the summer. We had the tanker attacks in the Strait of Hormuz, and yet didn't really move the dial on oil prices. But this is a game changer. Abqaiq is such a crucial part of the Saudi oil facility. Saudi Arabia is so important. It's the real swing producer in the world. I mean, there's not much else spare capacity around that can be brought on like Saudi Arabia, that has about 2 million barrels a day could be brought on at any one time. And that is being taken out while these repairs are going on. So that has really changed it in the short term. And also in the longer term, if you look further out, there's going to be a risk premium now, because until we get to the facts about how this was penetrated, because Abqaiq is very well protected, very well fortified. There was an attack in 2006, last time this happened, but it was a very different. They made extremely different security arrangements to ensure that this heartbeat of the Saudi oil industry was protected. And for this to happen, it will certainly put a risk premium on prices. S&P Global Platts Analytics, we see a $70 to $80 range while this risk premium is going on, but it really depends partly on how quickly this also comes back. I mean, we're still looking at the details, how it happened, how quickly it can get back to full production. So these are the facts, but there is definitely a risk premium going forward, as well as in the short-term spike we saw today.
When you talk about risk premium, Paul, sometimes it gets difficult to build in a risk premium. I mean, what's the risk premium which is appropriate in such a scenario gets difficult?
Well, it's true, but I think you can see definitely a $5 to $10 risk premium at the moment, and I know there's lots of people talking about, some analysts talk about $100 oil, but I think that's a little bit premature at this stage, particularly because we still need to know the exact details of what's going on, but I think ultimately it's about how many lost barrels, how quickly can barrels be lost from the market, and this is a new level. Like I was saying, it's Saudi Arabia, it's Abqaiq. It goes. 3 key fields serve Abqaiq. The Ghawar field, which is 5 million barrels a day. The Khurais field, which was also attacked, that was 1.5 million barrels a day of light Arab crude. And there's the Shaybar field as well. So those 3, Abqaiq also goes out to the east-west pipeline as well. So it's the other exit out of Saudi Arabia, not just through the Strait of Hormuz, but also out into the Red Sea. So there's also that factor. So it was, when you attack something like Abqaiq, that affects all parts of Saudi's export situation. And when you think about it, the 7 million barrels a day exported, that's the same level as coming out of Abqaiq. So there's really, you've got to think of what does this mean for risk geopolitically for Saudi Arabia, and for how quickly can other oil producers bring crude to the market. We've heard from the U.S. talking about the SPRs, Strategic Petroleum Reserves, but that's going to take a little bit of time to come to market if that was to be released. So really you're looking at some of the OPEC members and some of the Gulfies, which have some spare capacity. UAE probably has one of the most amounts of spare capacity. We also see like the geopolitical situation for OPEC, where we just had the meeting early in September talking about the laggards of compliance to this OPEC production cut deal, 1.2 million barrels a day, being Iraq and Nigeria. How does that shape the dynamic? They may have to continue pumping at will because to make up that shortfall in the short term.
But tell me something, given that others are also likely to step up when it comes to oil supply, how much is that likely to offset the price rise that has taken place? And do you still see that the prices will test $80 a barrel, or will the fact that others are likely to step in going to abate those concerns?
Well, I think it's a question of time and speed. How quickly can others fill the gap? And you're going to have, first of all, you're going to have what's going to be mitigated through some of this crude that's in storage in Asia and in India and China, for example. That'll be the first port of call. And then you'll also possibly see others make some supplies. Don't forget that Saudi Arabia has crude in storage as well, so that can also is a factor, and they can still supply a fair amount of crude from storage. So yes, there's certain factors which will mitigate the actual loss of crude in the short and medium term, but I think it's really shifted the mindset of the market and to what disruptions can have on the actual supply of crude, and that's a fundamental factor for the market to consider. And I think what you've also got to see is that if prices were to continue and stay around the $80 barrel mark, that you have, what does that play out to the demand scenario? Because $80 oil, you start looking into demand destruction territory again. You know, we've got these recession fears, we've got the demand slowdown fears. At $80 oil, that also plays into those problems again.
Okay, Paul, thank you so much for joining us and sharing with us your insights as well on this.